Hello and welcome to another episode of Macro Monday. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
My name's Cunliffe, a research analyst here at Onyx Capital Group.
And my name's Edward Hayden-Briffett. I'm also a research analyst at Onyx Capital Group.
Plenty to talk about this week. We'll be looking at equities again with the indices making new all-time highs. We'll be asking if this is a bubble.
We'll be unpacking some of the woeful data out of China, which surprised to the downside pretty aggressively.
And fund managers are suddenly chasing United Healthcare while crypto breaks lower.
But first of all, to the data last week, we had strong PPI out of the United States. Surprising, massive move, came in at 0.9% positive. Expected to come in at plus 0.2. That's a surprise to the market.
Yeah, I mean, it was pretty hot, especially after CPI, which printed, at least in the headline, pretty soft this month. Of course, the Fed targets PCE, and one of the inputs to that PCE number is PPI. So I think the market's leapt on it pretty aggressively, and we had a big move in yields.
And that's a good thing you brought up already, because the Fed, they focus on PCE, exactly. And JP Morgan, the flip side, are now talking about 4 cuts this year. You've only got 3 meetings, but the Fed have an inflation mandate. Inflation, the core is up 3.7% year on year.
Yeah.
The main number is up 3.3% year on year.
Yeah.
How does the market proceed from here?
Well, it's like 4 cuts in the 3 meetings is pretty aggressive, and I don't think JP Morgan is entirely right to be guessing that they'll be that aggressive on the Fed cuts, especially given the rhetoric. They're increasingly hawkish.
Yeah.
Powell's reiterating he doesn't want to jump the gun, even if he keeps getting called too late, however many times by Trump. And yeah, I think the OS is now 58 bips of cuts by the end of the year.
Yeah, absolutely. We should say that actually. That's what the market thinks. It's 58 basis points of cuts by year end. JP Morgan's going for one extreme, but we're having some pushback. We'll see later. Some of the Fed members are talking more hawkishly because, of course, we got Trump and Bessent calling for aggressive cuts.
Yes, and I think, the market does seem to want to be on the dovish side at the moment. We've seen the OIS be pretty volatile, but it seems to want to price more cuts. But if you actually kind of dig into what has been the driver of the soft headline CPI recently, it was all gasoline, it was all energy. And typically the Fed doesn't like to look at those more volatile components when targeting inflation. They look at the core measure. So having and we saw it the other way when gasoline prices really leapt up during the Russia-Ukraine war. Those sort of more idiosyncratic drivers of inflation, the Fed tend to look past. So that's true on the downside as well. So I think yeah, on the balance of things, a more hawkish outlook is probably going to be maintained by Powell.
Yep, and what I have here, we have the chart of the US 2-year government bond, and you can see it's actually in a very narrow range the last few weeks, but you can see it's targeting sort of 3.4% is the lower end of that, but it's been going sideways now for 2 to 3 years.
Yeah.
I know, I find it hard to remember a time where the market's been this, what's the word?
This sideways.
Yeah, sideways, indecisive.
Yeah.
And it makes the upcoming data even more crucial. I guess the next key data, we have some data this week. We actually, on Friday, we have Powell speaking at Jackson Hole. That's normally a market moving speech, an event, but then it's back to payrolls. But it just seems we lack kind of clarity and direction. And if we're seeing that, of course, the Fed members are seeing that as well. But meanwhile, as we said before, you've got Trump and you've got Bessent demanding lower
Well, I think
rates.
things might well be on hold basically until we get to the end of Powell's term, because that isn't that far away now. It's spring 2026.
Yep.
And depending on who they nominate as his replacement, there could be a rapid shift in policy direction, I think, if it's one of their more dovish picks.
I could see that nomination actually being market moving.
Yes, I think actually in reality, it won't make that much difference, because you've got to remember it's a committee, and power will remain on the committee, and the decision comes down to a vote by all of those collective committee members. Even if you were to put in a Waller or someone who's a little bit more on the dovish side as chair, their ability to actually influence policy too dramatically is not that great. So no matter who Trump nominates, I don't think he'll get his 3 percentage point reduction.
Other data last week, we had the University of Michigan consumer confidence. That's not highly correlated really to GDP, but one area that is fairly highly correlated is consumers' expectations on the labour market, and you can see how that correlates highly with a 6-month lead to unemployment. So there's concerns there about unemployment going higher. We've talked about this. Unemployment's already started to trend higher. And if we go on to the next slide, the National Federation of Independent Businesses, so small businesses, their optimism jumped. That came out stronger last month, up to 100.3 from 98.6 prior. But one thing that they're fretting about, noting about poor sales, is now the single most important problem. And that series, poor sales, is now the highest since February 2021. And that actually correlates highly with unemployment as well, as you can see from the chart here. I mentioned before, unemployment unfortunately trends. And at the moment it's trending higher. It is going slower because the participation rate's falling. But the economy, it's strong, but it's getting weaker.
Yeah, I mean, it seems like it's a no hire, no fire kind of labour market at the moment in the US. I would agree with that. I think you're completely right. The labour market does gather momentum, and once it's going in the wrong way, it's kind of quite difficult for the Fed to steer that ship back on course. So they'll be watching very closely. But, with unemployment in the 4s, I don't think they're going to be particularly concerned.
And it's low 4s as well.
I think it'd have to be kind of pushing 5% for them for the alarm bells to start ringing.
I guess this is what the market's looking at. Forward looking, the OIS and JP Morgan looking for 4 cuts. This is what they're pinning it on. And again, the Fed has the dual mandate, growth on one side, inflation on the other, and they're choosing to focus on the growth side. Or lack of. And on to China, we had weak data. This was actually a bigger surprise than the US PPI. Really weak data in China. Industrial production, unemployment, retail sales, and house prices were all weak. If I go through them very quickly, retail sales 3.7% year on year, expected 4.6, big miss. Industrial production 5.7, expected 5.9, that's not too bad. Fixed asset investment, only 1.6%, estimated 2.7. And unemployment rose from 5.1 to 5.2. House prices fell for a second month in July, down 0.3%. And you can see there, house prices, new homes and existing homes, and they've been negative for over 2 years now.
Yeah, I mean, China was kind of a source of optimism, I think, for a lot of people at the start of this year. We had GDP pretty strong for them, if you want to believe the numbers. It seems like that was largely due to the huge amount of stimulus that came in kind of Q3, Q4 last year, starting to pass through. And, even ourselves, we became really quite bullish on China. But it seems to be turning again and looking a little bit less positive. But again, I want to kind of err on the side of bad news is good news, and I think this is just going to be met with a whole host of new consumer repurchase programs. I think they're going to probably, PBOC have said they might pause on their easing, but I think, especially if we look at China credit appetite here, which is the value of outstanding yuan-denominated loan growth, and that growth rate fell to 6.9% year on year.
That looks catastrophic to me.
Yeah, I mean,
maybe I'm exaggerating, but it's one way.
Yeah, it's a systematic decline in credit appetite in China, despite repeatedly lowering reserve requirement ratios and medium-term lending facilities. All of the monetary easing that's come out of the PBOC hasn't managed to incite credit appetite in China. I mean, the flow of new credit is abysmal, really. Loan issuance fell by 50 billion yuan in the first, and that was the first monthly contraction since 2005. And that was missing forecasts of 300 billion yuan of new lending. So credit conditions in China look pretty poor, and I think that's going to be a key reason, a key drag on output in China and aggregate demand.
Also globally, China's what, 16% roughly of global GDP. And again, I agree with you completely. It's a surprise how suddenly this has changed. A bit like what we're seeing in Germany as well. 2 months ago, what looked like green shoots, strength, has suddenly halted. If we look at demographics as well on the next slide, that's only going to hurt home ownership as well. Here, projected change in Chinese population aged between 25 to 54. That's not going to help house prices at all. They need more stimulus for sure. On to Europe, and as mentioned before, the recovery, the strength in Germany seems to have suddenly stalled. Euro area ZEW economic sentiment declined 11 points to 25. German also fell. German ZEW dropped 18 points to 34.7. That's pretty catastrophic. French PPI just 1% year on year, and Swiss CPI is now in deflation, down 0.2%. And actually, interestingly, the OIS has only got, I have it written down here, 11 basis points of cuts from the ECB this year and a total of 17 this cycle through to next year. So the market's saying, okay, terminal rate's going to be 1.75, but we're pretty close. And actually, the euro looks like it's about to break higher. Key level on the euro is about 118.30. There's the euro charts. And right there, if it breaks high, two issues if it breaks higher. Firstly, of course, it's bad for the Eurozone. But secondly, it's going to be more dollar weakness. And it means the dollar will be breaking its long-term support. But again, this data's looking, Europe, China, it's suddenly turned in the wrong direction.
And, this is also off the back of, pretty huge fiscal from Germany, which did kind of motivate some optimism, especially in like the softer survey data like the ZEW. And that seems to have faded completely. I think perhaps had the talks with Trump and Putin gone a little bit better this weekend, I might start to think a bit more optimistically about the outlook in Europe, but it seems like that's going to be, that's kind of stalled. There's not going to be much progress there. And I think, Europe looks bad.
I think also like last year, while everyone was saying that China was really struggling and they were beginning to bring in all the stimulus measures, India was the kind of the bright spot, right, of the global economy. And now there are some warning signs from them as well. Their inflation rate is flooring, while the RBI still has rates up at like 6.5%. And that's massively constrictive for the Indian economy. They need to get cutting as quickly as they can, because otherwise they're just not going to be able to.
They've only cut about a percentage from their cycle peak, and they've got inflation just falling.
This is plummeting.
They need to get a hurry on and start cutting, I think.
It's interesting as well. I haven't got it in these charts, but I put on the morning review this morning. Now it's 54% of hedge fund managers expecting yield curve control in the US.
Wow.
And that's suddenly come from nowhere. But again, to get the cost of borrowing down. And again, what will that do? I guess this is what equities are looking at, because we'll come to equities in a second, but equities, all-time highs, the NASDAQ, S&P, Nikkei overnight as well. CSI in China is at 10-year highs this morning. Equities are loving it. The equity market is not the economy. It's basically surging off the back of stimulus and fervent buying in the US. On to the UK, better than expected GDP. That's with an exclamation mark. They're pretty low expectations, and annualized, this comes in at 1%. So that's not going to be enough to help Rachel Reeves and the budget. But also, if it fast forward as well in the UK, so better than expected GDP, although still pretty weak, and unemployment ticking up. So jobs lost last month was 8,000, The first quarter this year, 164,000, sorry, over the first year of this government, 164,000 jobs lost. So UK, again,
it's not looking great.
No, it's not looking great. It's a slow burn, but it's...
And also that upside surprise on GDP was largely driven by increased government expenditure. Yeah. So you mentioned the budget. They're spending even more with a big deficit, less revenue. You've got the increasing tax and then more outflow of actual taxpayers, high rate taxpayers. Yeah. So the actual balance is just tipping enormously.
It was in excess of 40% of the growth, I think, was government spending driven. And that has a whole host of crowding out effects and inefficiency that come with it, and it's unsustainable. I think the level of spending across a lot of Western countries is only going up, with very little strategy as how to tackle it. Issuance is increasing, and that's only going to elevate yields. And I think Rachel Reeves is going to have a tough budget coming up.
Yeah, with the autumn budget coming up, don't we? And she's promised no more hikes in taxes, but she's going to have to raise taxes.
She's going to have to raise taxes somehow. They've said not on working people, but I struggle to see how that their answer to not on working people is increase employer national insurance.
Obviously, it's a semantic argument.
Obviously, that gets passed through to the employee anyway, because it's an extra cost for the employer.
But also, that's what's driven the unemployment.
Exactly. So I think it's going to be a tough budget, and Labour seem very convinced that cutting back spending is not the correct option. We've had a lot of backbenchers pushing back on attempts towards fiscal sustainability.
It's exactly the same in the US, isn't it? They came in with Doge and cost cutting, and they've turned 360, and now they're trying to pump the economy hot.
Yeah, and in the US they'll point to tariffs. Tariffs have only generated about 140 billion of revenues compared to 1.6 trillion of deficit so far this year. So the rhetoric there is all completely wrong.
They're just trying to give headlines that make them look as if they're working and things are moving in the right direction, but clearly they're not. I mean, I think with Rachel Reeves, she's getting so much stick in the press. We're getting closer and closer to a Liz Truss moment, and the cabbage, and
yes,
I'm not. I don't think UK bonds look good at these levels, and the pound as well.
But I mean, that being said, the brief period a few weeks ago when we thought that maybe Rachel Reeves was on her last legs, maybe she was going to get fired, the market
in Parliament.
The market's absolutely hated that. Any replacement that comes in is going to be way less fiscally conscious than Rachel Reeves, I think. So that can only mean one thing for yields.
Interesting. And let's look at equities now. In the US now, 91% of fund managers thinks stocks are overvalued. Yet the S&P and the Nasdaq continue to make new all-time highs. If we look at, we were just discussing before we came on, PE ratios at 22.5, just below the 2000 Nasdaq bubble, and price to book ratios at over 25 now. That's the highest they've ever been. Price to book, so book rate ratio is assets minus liabilities. It's over 5.5 times. The long-term average is 2. So you're paying basically over 5 times the value of the assets of the company. Record levels, expensive, but the key is prices continue trending higher. Here you can see hedge fund managers remain short the S&P. Retail are going in. We'll see in a second. Leverage, huge. And here's the actual price of the S&P. You can see it's trending higher. You can see a raising wedge, but you can see we had a sell-off after employment at the start of this month. That low comes in at 6,200. Really, it's going to remain uptrend, remain a buy, unless or until it breaks below that 6,200 level. But you can see a raising wedge. Normally, these breaks to the downside. We can talk it's overvalued as much as we want. It's trending higher. But what I would say is it's not levels to be putting new money to work.
No,
for sure. If you're long, follow the trend, but certainly not levels to be buying new amounts. And if we look at leverage here, Money keeps pouring in. This is assets in leveraged equity exchange traded products. And you can see, that's got to be flashing risk warnings.
Yeah. I mean, as soon as, if we do get a downside correction in the S&P, there's going to be a lot of covering going on, I think. It could all spiral pretty quickly.
And what's interesting, though, we had the COVID sell-off over 20%, but retail didn't deleverage. So retail just held tight and it bounced. The Fed came in with huge stimulus. Of course, Fed can't come out with huge stimulus now because of the inflation concerns. Yeah. So whereas the retail got absolutely obliterated during the NASDAQ bubble and the financial crisis, they held it during COVID. So you worry if it's going to sell off, they'll try and hold it to start with and
then panic and sell.
Exactly.
It'll just spiral from there.
Exactly.
Especially if they're massively over leveraged.
Yep.
So
that's typically what happens. But for now, it keeps trending higher. Do you guys think it's a bubble, equities?
I mean, I don't think you can argue with some of the ratios that come out, like Palantir, price to earnings that we discussed last week. The price to book. I mean, the price to book one at 5.5, that kind of makes sense given that a lot of these big companies are tech companies. So they're going to be they're going to have big valuations based off of forward earnings as opposed to current assets minus liabilities. But nevertheless, I think these ratios, like you say, it's not levels to be getting into new positions here, for me at least. And I think, the risk to a downside correction is mounting.
Yep. I largely agree, although for US equities at this point, you have to consider them in a slightly different class to the traditional interpretation, because it's just all the US 401ks they're put into the S&P, basically. You got foreign investors as well, and it's just kind of the safe equity market. So although you have this kind of distorted PE ratios and other indicators, there are other factors like the psychological aspect of it that is just the US is kind of the stock market where you put your money and it always goes up. So I think until that impression and idea breaks, then it could just keep grinding up.
An interesting one with the equities as well. Last week, Warren Buffett announced, Berkshire Hathaway, that they bought a significant stake, 5 million shares in United Healthcare. Here's the chart of United Healthcare. It looked pretty sick, to say the very least, but you can see it suddenly jumped last week. And all of a sudden, not only is Berkshire Hathaway in there, but Dodge & Cox hedge fund have 4.7 million shares. David Tepper, Appaloosa, 2.2 million shares. Renaissance Technology, see all the famous funds are in there. Renaissance has 1.3 million shares. Michael Burry's long of calls. Saudi Arabian Public Investment Fund is long of calls. Soros and Steve Cohen are in there as well.
Yeah.
And you can see this is going to be a classic example. And all these hedge funds, they're all there for long term. There's actually a very small float remaining of shares out there. And all of a sudden, the retail are going to see this jump in, and I'm pretty sure that one's going to go a lot higher. Yeah. And if you're going to play stocks on the long-short side as well, this would be a classic long to take on against maybe a short if you want to short something like Palantir.
Yeah.
On to Palantir. And you can see we had a gap higher about 3 weeks ago, and you can see actually late last week it started to roll over. Key support there is $160. That's where it broke from. You'll see support. If it breaks below there, guarantee you'll see aggressive selling. Trump administration's discussing taking a stake in Intel. This is the Intel chart. It suddenly jumped 20% over the week last week. Funnily enough, just before that was announced, someone bought 1,500 one-day calls for 5 cents, and the stock suddenly jumped 10% on the news. Something I find slightly unprofessional with Donald Trump and his administration, and that's an understatement, is the amount of grift that seems to be going on here.
Yeah, well, we had the same back when he delayed his reciprocal tariffs, right? There was a sudden spike in activity about 4 hours before they were announced, and then they announced it and everything just roofs.
Just before copper was announced, big purchases there, and also Brazil tariffs, dollar Brazil, large purchase there. It's just blatant dishonesty. I mean, how long will people put up with this? You see more and more, or it gets flagged more and more in social media, but people get away with it. Nancy Pelosi and so on.
Yeah. Although they are trying to pass a bill now, I think, that will prohibit
single stocks, right?
From trading stocks, which makes sense. I mean, we have similar legislation in the UK that limits your ability to trade if you're in a policy making position. It's crazy to me that they don't in the US already.
But if it's you or me, one of us would be
who could
straight
refuse
to jail.
that deal?
Exactly.
Yeah.
Unbelievable. Tesla. What's happening with Tesla? Well, it's broken out. You can see a sort of triangle there, bit of a lackluster breakout, but again, short term, it's still definitely trending higher. And with the Fed members, so Donald Trump last week called for immediate rate cuts, threatened a lawsuit against Powell. Besant saying we could have a 50-point cut in June. But some of the Fed members are now fighting back. Fed Daily said a large rate cut next month doesn't seem warranted. And Fed's Musalem said a half-point cut is not supported by the state of the economy or the data. Flip side, though, a potential Fed chair pick, David Zervos of Jefferies, who Donald Trump slated as a potential, he suddenly said aggressive interest rate cuts are warranted. Of course, he wants the job, and that's his way of putting his CV in.
Yeah, I mean, we saw the same from Waller, didn't we, a few months ago, coming out super dovish, just as Trump is saying that he wants to replace Powell with someone more dovish. They're gunning for the top spot, I think.
Yeah, trying to please the boss. It's a bit like a soap opera, this, isn't it? It's unprofessional again. Dollar yen. If we look at currencies now, dollar yen, the interest rate differentials. We've looked at this before, but you can see now the white line is 2-year dollar minus 2-year yen. Clearly now it's favouring the yen, and this would imply dollar yen should be trading lower. Again, dollar, we mentioned earlier, 110 basis points of cuts over the next 12 months. Japan, the market's pricing 37 points of hikes. They have stronger inflation there. So this implied dollar yen potentially lower. If we look at the long-term dollar chart, you can see here, going back over a decade, you can see we're sitting here right on key support.
But I mean, the short dollar is still pretty crowded.
I'd say we've had a clear out in the last month.
Oh, interesting.
Potentially, some of it unwind of that. But I agree. It's it needs new news to break these lows.
Yes.
If I fast forward very quickly before I come back to you, you can see the very short-term chart here. We've had a slight rally, so some of the shorts have been unwound, but you can see we're sitting on support there again.
Yeah.
But for this to break lower, it does need.
But then the headline fatigue is really set in. Like all the new tariff announcements Trump's put in come into effect in early August, and markets are
I mean, also
so you need something dramatic.
That downtrend that we kind of saw earlier this year, that was largely driven by capital outflow. A lot of concern over, partly to do with fiscal sustainability in the US, also just Trump's erratic policy, I think. But we seem to have kind of bottomed out on that a little bit. No matter what Trump is saying, we've not seen a similar reaction to the most recent wave of tariffs, for example, in the bond market or in equity markets or in the dollar. So I think to me that says that people who were going to pull out from the US have done, and we've kind of reached a cap on that capital outflow for now.
I think, Ed, you're right. We need it's headline.
The market's just fed up of the erratic policy making, and it will take, I think, something more than that, something maybe structural as a more kind of systemic decline to break it out, rather than just a piece of news like Trump saying more tariffs on China, tariffs on India, whatever. So
I feel like with the data we've had this week, it's been largely unexpected, be market moving, but markets are really not really much happening. I guess part of that is summer. We're getting close to the end of August. Markets typically pick up again in September. Volatility. But it's been a very, very quiet couple of months. On to Brent. Brent remains in our range. What's happening here?
Well, the big story has obviously recently been the Russia-US talks in Alaska last week. And it has very much felt like the oil market is just kind of on wait and see mode. Wait and see what Trump says, what Putin says. And out of that meeting, there's nothing really concrete yet. It seems that Trump's tried to push the ball back into Zelensky and the Europeans' court. They have a meeting today, and maybe we'll find out some more. But it does look like there's going to be some relaxation of the sanctions and restrictions on Russian supplies, because you've got already some LNG cargoes going around the north of Russia, and Exxon's being allowed to return to its involvement in the Sakhalin-1 project. So maybe there will be some relaxation to come from those sanctions.
Yeah, and I think the market was going into those meetings pretty optimistically. I think they were gunning for for some sort of resolution. I mean, I'm a bit pessimistic as always with these things. I don't foresee any sort of meaningful resolution. Putin has remained pretty resolute in his objectives in Ukraine, and his narrative is consistent with that when he first invaded. So I don't think he's going to budge. And I think Europe, especially if Trump is now pushing the ball more into Europe's court, Europe aren't going to concede either. No. They're doubling down as well. So I think it's going to drag on.
I agree.
And the sanctions, they rerouted flows for sure. So Europe took less Russian crude, but China, India, they're still buying, and they won't stop buying.
A ceasefire and reduced sanctions, remove tariffs and everything, that won't actually really change much in terms of the volumes on the market. It'll just, like you say, reroute them, send them to alternative destinations. More differentials that will be moved than outrights.
I think, and what's really been driving markets recently, I think, is more to do with China buying. The amount of crude that China have been stockpiling, because initially there were these huge surpluses in every analyst's oil balance, and a lot of that was going to strategic stockpiling in China. And that seems to have slowed a little bit in the last month. Allocations were down in China, and it seems like they've taken the foot off the pedal. At the same time, they're starting to increase their run rates in their refineries. So we're seeing a little bit of an uptick in demand from China, but nevertheless, their strategic stockpiling seems to have slowed. So I think that's going to soften the curve a little bit. But then again, if you look at positioning in WTI, like CFTC data, we're at all-time record shorts across ICE and CME for managed money positioning. That's a hugely crowded position, which will kind of cap downside on flat price. I think.
I agree. I don't see much more kind of scope for moving to the downside. I think this range is quite comfortable for now. I can see it going maybe a little bit higher, but mid-60s does seem pretty safe.
Seems like we're in a pretty tightly bounded range. So no volatility in the foreseeable future from where we're sitting, at least.
Do you see this week Chinese data have an impact going forward on oil demand?
So I think the demand story in China's complex. I think we have seen a resurgence in the consumer to an extent in China. A lot of that has been driven by subsidies, and those subsidies are targeted specifically at EVs. So while you may have retail sales, although it printed softly this month, you may see retail sales for vehicles printing quite strong, and we have seen that. That's all to do with the EVs, the subsidized EV purchases. And that obviously does the opposite for oil demand. That weighs on oil demand. So we've got quite a complex mix at the moment. But it's also important to remember that China is huge. So even if they have a tiny increment of growth, that means a lot of barrels demanded. It'll be interesting to see how it plays out. I think further stimulus, especially if they try and broaden the stimulus, because remember, so far the stimulus from the CCP has been really quite targeted at certain key strategic sectors. If this recent softening in the data does continue and we see an extended decline, more broad based, I think they will open the remit for their stimulus and issue more broader measures, which then could pass through into oil demand more effectively. So that's one thing to watch out for sure.
Interesting. We move on to other commodities. Gold. Here you can see a gold. You could either draw a triangle pattern there, but there's also a triple top around 3,430. Either way, it looks like a continuation pattern, but it's been here since April.
Yeah.
It's okay to sit and wait, but it looks like it's going to break higher. But again, sit on your hands and wait for the breakout.
Yeah.
Bitcoin, on the other hand, interesting price action there. It looked last week like it was going to break higher. And actually, we've reversed backwards in the last 3 or 4 days. It's down another 2% today. You can see there, I've put a support line. That would be 112,000. If it breaks below there, that's when we'll see stops triggered. But what looked like a new breakout, an aggressive move higher, suddenly it's reversed. I don't know what's driven that. If we move on to Ethereum, the next chart, you can see exactly the same. Ethereum's down 5% today. But again, it's trading at mid 4,000. Standard Chartered came out last week calling for 7,500 by year end and 25,000 by 2028. But what goes up that aggressively typically falls just as aggressively. You can see some longs being around here and pretty pricey, pretty volatile price action. OAS pricing, we've mentioned before, 110 basis points over the next year by the Fed. Some extremes out there. JP Morgan looking for 4 cuts by year end. ECB only 17 basis points, so not even one full cut the market's looking for. I suspect the market will look for another and get another going forward, especially if inflation continues printing lower and lower. A chance we see deflation in Europe next year.
Yeah.
Bank of England, 44 basis points. We had a cut 25 basis points by the IBA last week. That was fully expected. But again, Bank of Japan, markets expecting 37 basis points of hikes there. A fairly quiet week of data this week. Wednesday, we have the Fed minutes. That's old news. UK and Eurozone inflation. We have flash PMIs on Thursday out of the UK, Eurozone, US, multiple countries. And probably the biggest potential market mover is Friday when Fed Chair Powell speaks at the Jackson Hole conference. But as we said, lots of data coming out. You'd think the market would be volatile, but prices aren't really moving that much at the moment.
No.
Any thoughts for the week ahead?
I think the biggest market move will be really, well, until Jackson Hole, will be the Russia-Ukraine story. What comes of that? If you have some kind of breakthrough ceasefire or progress towards peace, you could see some more optimism across markets, but I think that possibility is quite unlikely, frankly.
Yeah, possibly if we see a bigger move from some of the stocks like Palantir or Bitcoin, Ethereum, that could start to make a bit more news. But otherwise, have a great week and we look forward to seeing you next week. Thank you very much.
Thank you.